Next is capital budgeting process. The capital budgeting process is the process of identifying and evaluating capital projects, that is, projects where the cash flow to the firm will be received over a period longer than a year. For a number of good reasons, capital budgeting may be the most important responsibility that a financial manager has. First, since a capital budgeting decision often involves the purchase of costly long-term assets with lives of many years, the decision made may determine the future success of the firm. Second, the principles underlying the capital budgeting process also apply to other corporate decisions, such as working capital management and making strategic merger and acquisitions. Finally, making good capital budgeting decision is consistent with management's primary goal of maximizing shareholders' value. So it's all about maximizing shareholder value. All the department of a company is working for maximizing shareholder value. As financial manager, most important responsibility to maximize shareholder value. The capital budgeting process has 4 administrative steps. Number 1 is idea generation. Second is analyzing projects proposals. Third one is create the firm-wide capital budget. Fourth one is monitoring decisions and conducting a post-audit. What is idea generation? The most important step in the capital budgeting process is generating good project ideas. Ideas can come from a number of sources, including senior management, functional divisions, employees, or outside the company. Step 2 is analyzing project proposals. Since the decision to accept or reject a capital project is based on the project's expected future cash flow, a cash flow forecast must be made for each product to determine its expected profitability. Third step, create the firm-wide capital budget. Firm must prioritize profitable projects according to the timing of the project cash flow, available company's resources, and company's overall strategic plan. Many projects that are attractive individually may not make sense strategically. Step 4, monitoring decision. It is important to follow up on all capital budgeting decisions. An analyst should compare the actual result to the projected result, and project managers should explain why projection did or did not match actual performance. Since the capital budgeting process is only as good as the estimates of the inputs into the model used to forecast cash flow, a post-audit should be used to identifying systematic errors in the forecasting process and improve company's operations. So, in these 4 steps, we see that idea generation is most important, and it's the first step. When idea generated, project should be analyzed. One most important thing in the project proposal is forecasting the future cash flow. If forecasted is accurate, then all other indicators calculated correctly in order to take decision either project should be accepted or rejected. Third one is create the firm wide capital budget. Financial manager should see, is this possible for the company? Are the resources of the company enough to take the project? Monitoring decisions and conducting a post audit. Fourth one is also most important, to conduct a post audit or see or check the forecasted cash flow is correct or not. If estimated cash flow is correct, then it's easy to implement the other indicators in order to accept or reject projects. Next topic is categories of capital budgeting projects. Capital budgeting projects may be divided into the following categories. Replacement project to maintain the business. Capital budgeting project may be divided into the following categories. Replacement project to maintain the business. These projects are normally made without detailed analysis. The only issues are whether the existing operation should continue, and if so, whether existing procedures or processes should be maintained. Second category is replacement projects for cost reduction. These projects determine whether equipment that is obsolete but still usable should be replaced. A fairly detailed analysis is necessary in this case. Third one is expansion projects. These projects are taken on to grow the business and involves a complex decision making process, since they require an explicit forecast of future demand. A very detailed analysis is required. Fourth one is new products and market development. This project also entails a complex decision making process that will require a detailed analysis due to the large amount of uncertainty involved. Second last is mandatory projects. It may be required by a governmental agencies or insurance companies and typically involve safety related or environmental concern. These projects typically generate little to no revenue, but they accompany new revenue producing projects undertaken by the company. Last one is other projects. This is the categories of capital budgeting projects. Some projects are not easily analyzed through the capital budgeting process. Such projects may include a pet project of senior management, for example, corporate perks, or a high risk endeavor that is difficult to analyze with the typical capital budgeting assessment method. Research and development projects. So other projects include research and development projects where financial indicator not suitable. These are called other projects. So these are the categories of capital budgeting process. This is not required detailed analysis. It requires more than first categories. and expansion projects require detailed analysis. It means forecasting should be accurate, as well as new product or market development also including high risk. So it also required detailed analysis by the financial managers and corporate management. These are the categories of capital budgeting process. In this topic, we will know how to calculate all of the measures used to evaluate capital projects and the decision rule associated with them. After this learning, we can interpret an net present value profile. You could be given a part of a question. Finally, know the reasoning behind the fact that internal rate of return and net present value give the same accept reject decision for a single project, and internal rate of return and net present value can give conflicting ranking for mutually exclusive projects. In this topic, we will learn all these things in order to choose projects in capital budgeting process. Bismillahirrahmanirrahim. Today we will discuss capital budgeting. What is capital? Capital is a money, is a financial asset. Capital is a financial assets. Financial assets includes cash, bank loan, equity, what does mean by budgeting? Budgeting means how to spend financial assets. So it's mean financial assets spending, mean how we can spend money in order to maximize shareholders value. So company's overall goal is to maximize shareholders value with social responsibility, and finance is the backbone of the company. So financial manager should spend money in order to get maximum shareholder value according to social responsibilities. So in simple words, we can say capital budgeting is a spending of financial assets including cash, bank loan or shares value in order to get maximum profit in long term assets that are more than 1 year. This is a very simple and concise definition of capital budgeting.